It is March 31st, and this is of course the video log that takes 30,000 to a million. I will show you what the account is at, and after that I want to talk about using Robinhood's margin as collateral for your options. It's a bit tricky, so I'm going to explain it in detail as best as I can after I take you through the account. I am sitting at 149,000, a little bit over. My account hasn't been changed in so long. I've kind of lost track as to what the heck is going on with the account because it's been so flat for so long. Look, nothing over the week, like 4% or something over 1 month, and basically 0% over the last 3 months. So this is the year. Oh wow, okay. Had a good year, but the last 3 months have been completely flat. In fact, I'm only up about $3,000 in the year, maybe $2,000. So very interesting. Quickly going to run through the options, and then we'll talk about margin. Okay. I have a ton of UBIX options right now. I'm going to scroll down really quickly. You can pause the video at any moment to try to figure out the exact positions. You can see the ticker here, the strike price, whether it's put or call, expiration date, number of contracts, whether it's a sell or buy, and the number on the right represents the change in liability of the activity. I'm slipping down into the stock positions now. A bunch of UBIX, a bunch of Apple. Together they represent about 50% of my account, so I'm making really big plays on these two companies at the moment. Here is the rest. DEM has the plus sign because it's reinvesting a dividend that I've received overnight, and that is why it means that there's a trade being queued. That's what that plus sign means on the right. I'm going to be doing some education for those of you who don't know. If you do know, that's fantastic. Let me know how it's going. Oh, by the way, I picked up 100 shares of Leap now that it's gotten almost at $10. That is the Leap is a SPAC. They ran by Ribbit. I didn't want to buy it over $11. It went all the way up to 16, and they may take some interesting company public, so I'm keeping my options open when it comes to that. I may sell it at some point if I need the money for something else. But I also don't know when their expiration date is. There's some strange stuff that goes on with the specs that can go down dramatically in value, and you need to know the date, so I haven't actually looked it up. But I'm pretty confident that if they do run a public, if they do take some company that's public, they're not going to do too badly. So I looked at their portfolio and they have some really nice companies on there. Anyways, so that's enough talk about the account. So I want to talk to you about using Robinhood's margin debt, or I don't know if other brokerages do it this way, they might, and show you how to do it and why strange things happen when you try to use margin as collateral. So what you may have noticed, if you try to, let's say for example, sell a put option for $5,000, so a strike price of 50 of some option, that your margin gets reduced by $10,000, and it shows only $5,000 collateral, but your total margin gets reduced by $10,000. And so you might be wondering, well, what the heck? Why is this going on? I only want to use $5,000 my margin as collateral, but Robinhood lets you operate with 50% because of this scenario here that maybe I'll open up the site and show you. But I want you to imagine a scenario where you have $100,000 in your account. Well, okay, so $100,000 margin. Let's say you have $100,000 in the account and you have $100,000 extra margin, right? And so now you're executing this put option. You're selling the put, and you need to put down $50,000 collateral. So theoretically, you should have another $50,000 of margin left, but you don't. Now you have zero margin left, and the reason being is that if Robinhood wants to be symmetrical, so if your position goes down to zero or close to zero, and you want that put option is going to exercise, and you're going to be forced to buy that many shares, $50,000 worth of shares at a very, very low price, let's say close to zero. But now, because your account is so much smaller, right? You've lost a lot of money now. Your margin proportion will not be the same. So Robinhood basically assumes that if it goes to zero, it needs to have the correct proportional amount of margin on the other side of the value of your account. And let's suppose, for example, that you've sold puts on, the rest of your account is also, let's say, selling puts for the same thing. So you sold like 3 puts, 2 of them for $50,000 with the money you have, and one $50,000 on margin. Yeah. And so now when your account goes to zero, Robinhood doesn't go under. Okay, so it's kind of a complicated thing to think about. You can try to play the scenario in your head. I do not have any kind of graphs or anything like that prepared because I've been so busy lately. I haven't had time to prepare properly for these videos, but I did have a request to try to explain that. But and I'm trying to do my best. If you have a better explanation, either a video about it or you can type it out in the comments below. I'm super glad to, or we'd be happy to read it and or watch the video that you refer. And I will point other people's to watch it if there's a better explanation out there. I just haven't searched, no time, etc. But I did want to update y'all on the account and show you what's going on. So that is why there's this kind of double margin usage when you're using your margin for collateral for your options. I hope that explains things. If you have further questions, I will do my best to explain. Maybe I'll make another video. But as of now, it's the best I can do here. Okay, so if I want to sell a put option on EBIX, then it says over here I have $13,000 of buying power. So if I sell an option that's going to require $3,000, it will actually take out 6. So I'll actually be able to sell about 2 put options for a $30 strike price on EBIX if I wanted to do that with the amount of buying power I have left in my account. So that's an example, a quick math here on how much margin I would need to have in order to execute that trade. If you want to see the details, by the way, on my EBIX position, here they are. My stock is actually down just a little bit, a few dollars. And then my option plays, I'm actually winning on my option plays. And in fact, I've already closed down quite a few option positions. So I'm probably almost even on this right now, sitting at 31.33. Just as an update. If this works out for me, this is going to be a big hit. I'm kind of waiting on this event to happen on April 20th and see if there's going to be some major account shifts here. And if not, I'm just going to wait this rotation of the markets out, from growth to value, or whatever you want to call this rotation that's going on, whereas the markets are scoring close to all-time highs, but all the growth stocks are just crashing. And we'll see what happens. But I'm going to keep this short and sweet. Hopefully you'll have a better explanation than I did about the margin usage for Robinhood. And if you do, let me know in the comments. Also, I think that's about it. Peace out.